And what BIS does is sort of like highlight risk more than we highlight what's going well. So maybe I will highlight more of the risks, but it doesn't mean that the situation is particularly bleak. So, like last year, we had a very forgiving global liquidity environment, and Ukraine, just as other emerging markets, enjoyed very easy funding conditions, and it placed a 15-year bond. Also, beginning of this year, investors were quite overweight Ukraine. The currency was one of the best performing currencies in the first half of the year. I think hryvnia appreciated something like 7%, maybe more. And that was kind of a general theme for actually most emerging markets. But since a few months ago, it was obvious the situation has changed. The Goldilocks is sort of, that environment has come to an end. And maybe some of the complacency that had set in among some in the political circles in Ukraine that these easy funding conditions are going to continue for a long time, and we can maybe even avoid relying on IMF. That is gone now, and we're back, looks like, cooperating with the IMF. And that is actually a positive development of what has happened. But it's going to be challenging going forward because the risks for emerging market funding are skewed to the downside. I mean, you have US monetary policy tightening. You also have US fiscal expansion in such a late cycle of monetary policy, which also de facto raised short-term interest rates in the US and further tightened funding conditions globally. You have this bizarre situation where, on the one hand, we have oil prices rising, but then we also had US dollar strengthening. Again, that presents a challenge for emerging markets dependent on external funding. Finally, trade and political uncertainty doesn't help emerging markets and Ukraine as well. So maybe I just say one more thing specific to Ukraine. In terms of external funding, most other emerging markets by now are kind of moved beyond original sin, and the governments have been able to issue local currency bonds and place it with international investors. So far, Ukrainian government relies primarily on foreign currency debt, and a lot of it is short term. And at the moment, short-term funding has been secured from the IMF. Also, as a fallback option, Ukrainian banking system itself has quite a bit of FX deposits interbank, and those can be invested in Ukrainian government paper to keep rolling over the short-term debt. But over a longer run, the focus must be on the kind of changes that will bring in stable long-term funding, FDI, foreign currency capital inflows, and that brings us back to really bringing your house in order. Ukraine must proceed with land reform, privatization, agricultural reform, and this then means that even though external funding is a very important source, what will bring stable external funding is bringing one's house in order. In addition to that, it's very important to have solid domestic macroeconomic institutions, develop domestic financial markets, and domestic regulatory environment. I mean, these are not my original thoughts. This is just what IMF prescribes as the first best in terms of attracting the most stable capital inflows. For example, just to give you one example of the kind of markets that Ukraine may need, at the moment, it's very difficult to induce domestic financial institutions in Ukraine to buy local currency hryvnia government paper. Well, why is that? That's because Ukrainian banks, private banks, rely quite a bit on foreign currency funding because of the lack of derivative markets to hedge that funding, they have to match it directly with foreign currency bonds and other foreign currency assets. If Ukraine were to develop a robust market for hedging instruments, among other things for currency risk, it will also help develop local currency bond market so that to reduce government's reliance on solely on external investors. Maybe I'll just take a pause here.
Sure. Can I